So let's look at a scenario where in real life. So here is our fictitious stock OICX, and the investor is long 100 shares of stock and decides to sell a covered call in the hopes of generating premium income. Okay, so let's just say the shares that we bought them for 95. We sold the 100 level call for $5, 45 days out. At expiration, the shares close at 102. Okay, those calls, that 100 level call is $2 in the money. If we do nothing, we're going to get assigned. Okay, and if we're comfortable getting assigned, we just get assigned. And now we're going to have $10,500 in our account because once again, we bought shares at 95. By getting assigned at the 100 level call for $5, we're essentially making $5 on our stock price, and we're pocketing $5 in the premium income. That's a total gain of $10 or 10% on that particular 45-day investment. And now we have cash in our pocket to put on a cash secured put once again. So now we have cash in our pocket. We have $10,500 to invest, and we choose to sell a cash secured put with the stock trading at 102. We're looking at selling the 95 level put, and we see that another 45 days out, we can sell the 95 level put at $4.70. So now we have to deposit $9,030 to cover the risk of any potential assignment. Okay, once again, that idea of a cash secured put. And let's just say at expiration, we fast forward to expiration, and shares close at 93. Well, if we do nothing, now we would surely get assigned at our short 95 level put. We would own shares, okay, effectively from 90.30, because remember, we took in $4.70. We take that away from the 95 level strike that we sold. That's where our break even is, okay? So we'd be sitting on an unrealized gain, effectively long stock from $90.30 with the stock trading at 93. And once again, if we get assigned on this put, now, even though we're going to be long the stock from 90.30, we could sell another covered call, maybe at the 100 level strike or the 105 strike. Once again, it's up to you, depending on your personal preference. But this is that idea that you're going to repeat the cycle with another covered call. And it doesn't matter whether you start this position with a covered call or a cash secured put, but the idea is once you get assigned on one of the positions, you're going to have, in the case of a covered call, you're going to have cash on hand, and you're going to use that cash to securitize a cash secured put. And if you get assigned on the cash secured put, you're going to have to pay out money to own that stock. And once again, you would sell a covered call against it to once again take in more premium income and to lower the overall break even price of those shares that you got assigned on.